My name is Tim Pierotti. I am joined with Drew Dokken. We're going to spend 5 minutes running through our Q2 quarter in review and our outlook for the second half of the year. I'm going to make 5 quick points about our view of the U.S. economy and markets. We'll then talk a little bit about what we see internationally. We'll talk about commodities. And then Drew is going to pick it up and talk about some of the survey work that we've done and also the data that has come in the first half of the year on both annuities and equity structured products. So one theme, one catchphrase that we've had for this year has been sideways is fine. Our view is that the U.S. economy has and will continue to kind of move along slowly. Not very fast growth, but fast enough. And our view is that we do not see an imminent recession. We don't see the economy reaccelerating either. But for various reasons that we go into in the report, we don't see an imminent recession. Now, we realize that what we are saying and what consensus is saying, frankly, is that this time is different. Because historically, as you can see from this chart, when unemployment has started to come up off of full employment, you get a recession. And the track record on that is outstanding since the end of World War II. The same is true for when you have a curve disinversion, right? The yield curve has been inverted for some time. It is in the process of uninverting. And usually when that happens, you get a recession. The same can be true when home sales, when new home construction really starts to roll over, you tend to get a recession. We are saying it's different this time. And why shouldn't it be, given this whole cycle has been so different, right? This has been a cycle driven by massive fiscal spending, right? We have $2 trillion deficits. We printed $7.5 trillion within the pandemic. We have created a tremendous amount of wealth. Well, government debt has obviously grown significantly. Corporate and personal balance sheets are in pretty good shape. Now, there are indicators of the consumer being under pressure, but we think this is really limited to the lower cohorts of U.S. consumers and doesn't tell us anything like what it told us in 2008. One of the reasons we stay constructive, no pun intended, is because we are constructive on housing. Housing is weakening a little bit. The existing home market, though, remains extremely tight. Prices are still up in the existing home market year over year, though less than on a rate of change basis than they had been. But the new housing market is where you see weakness, where you see significant inventories, especially in states like Florida and Texas, and in the multifamily market, where you are starting to see some weakness as well. But overall, in very simple terms, we still see more buyers than sellers. We do not see a housing market that is going to drag down the U.S. economy. Will unemployment continue to rise? And likely some of that will come from the cyclical nature of less construction in the new home and in the multifamily market. We think it will. But ultimately, there are more buyers than sellers. And one of the reasons why we say that is even though affordability is as poor as it is, that doesn't prevent when you have a existing home for sale in a community like I live in Summit, New Jersey, or where Drew is in Bozeman, Montana. And those might be exceptions, but the overall, away from certain areas, demand for housing remains very, very strong despite the weak affordability. We think a lot of that has to do with the generational wealth transfer. Look, we have created a tremendous amount of wealth, both stock market gains and housing gains. People have never had more equity in their houses. That wealth is starting to make its way into the next generation. The peak of the baby boom generation is sort of the early 19 and into the mid 1950s. Baby boomers are turning 70 and they are starting to bequeath wealth to the next generation. And that is driving more demand for housing from those who are fortunate enough to have some money coming from the previous generation. Now, where we are less constructive is on the idea of inflation. Now, we believe that the Fed will be cutting rates in September. They'll probably cut rates again in December, but there's going to be a lot of data that comes in the third and fourth quarter of this year that may not look as weak on the inflation front as the July and the August data has and will look. If you look at the fact that shipping rates have moved up significantly, that the base effects are very different. In other words, the compares get easier as you move into the back half of the year. We think that there will be an ongoing issue of inflation. Even though employment has weakened, you still have 4 and 5% wage gains. If you listen to or read the NFIB reports every single month, you see that employers are still, their number one concern is the ability to find labor and the cost of that labor moving up. I don't mean to steal Drew's thunder, but he's got a report from some of the survey work that we've done that shows that the number one concern of Americans is higher inflation. Inflation expectations remain very, very sticky, and that to some degree can be a self-fulfilling prophecy. So we do not believe that while we see the Fed cutting a couple times here by the end of the year, we don't think there will be 6 Fed cuts. Where we are also not as constructive as perhaps consensus is in the idea that investor sentiment is euphoric. The city panic euphoria meter has been stuck on euphoria for a little while. That historically has foretold poor returns going forward. And look, along with our sideways is fine theme, we have argued that we could remain in a risk-on environment until something meaningfully changes. Well, we don't see a recession, but we do worry that the yield curve inversion and a higher 10-year yield, which could be negative for housing, could be that part of the economy that does upset the apple cart a little bit. So one of the last things that we say in this report discussing the economy and the markets is that stops are your friend. The momentum, the risk-on momentum, passive flows, 401k flows, young people, money moves from lower velocity assets in retirement accounts into higher velocity, your kids' money, your kids' willingness to buy a house, buy a car. That's all very bullish to invest in stocks with that money. But if we see unemployment move higher, not our base case, but again, if we do see unemployment move higher, if you do see confidence start to weaken in housing, which alone will weaken housing demand, then you could see a really meaningful market sell-off. And in that case, we really do recommend that people use stops because the momentum that has driven this market higher could be a similar dynamic on the way down. Let me just talk very briefly about what we see in commodities. We remain bullish long-term on commodities. We are long-term oil bulls. There's no change there. We know that there is excess spare capacity right now, but overall, our view is that we will continue to underinvest in long-term resource growth while there is the enduring strong demand for hydrocarbons in emerging markets that we believe will continue to be strong and acyclical. Copper is coming off the boil here significantly in the last few weeks as it becomes clear that China is falling deeper into a recession. China is selling excess copper reserves. We see that as a long-term opportunity because we believe that if the world is going to be electrified, there is going to be a lot more demand for copper, and the same dynamic of underinvestment is true, but only to a greater degree in the world of copper, and we remain bullish gold. Our fear is that the United States and other central banks and other governments are rapidly losing credibility. And we inserted an essay in this piece about the future of Maganomics. Should the Trump presidency occur, we think it'll be highly inflationary. We think that tariffs are unambiguously inflationary. We think that we very much need the labor that has come into this country. And if we have mass deportations, you are going to see a labor shortage and you are going to see a spike in demand for higher wages. So those are kind of our sentiments around the economy, around markets and commodities. Drew, why don't you take a minute to talk a little bit about our view of Europe, China, India, and also some of the work that we've done, some of the survey work that we've done, as well as a look at the data driving such growth in annuities and equity structured products?
Absolutely. Thanks, Tim. Europe somewhat recovered quite nicely, I'd say, over this past quarter. When we're looking at the May 17th inflation report, we saw that there was a steady price growth at 2.4%. And we've actually seen Southern European countries outpace kind of the typical big markets such as Germany and UK and France. And that's kind of been a trend that's occurred the last couple quarters. What used to be what we'd call the pigs, Portugal, Italy, Spain, Greece, have seemed to recover a little bit better post-COVID than some of the larger economies. We also see that, countries outside the, European Central Bank zone, when you're looking at Sweden and the Czech Republic, they've both begun to cut rates. And one thing that is obviously a consternation in Europe, but the same in the States, is there's a lot of political bifurcation. We've seen that we have right-wing parties ascendant in the parliamentary elections, but people are just unhappy overall. We also saw that in the UK elections, right, where the Tories had the biggest wipeout that they've had really going back to the inception of their party back in the 1800s. So people are just generally unhappy with the status quo and their leaders, whether that's right, whether it's left. And we've seen that in Europe's elections, despite the fact that they seem to be recovering. China growth exceeded in at least the first quarter expectations, and that's kind of been the constant throughout the Q2. We've seen upticks in manufacturing, higher PMIs, so manufacturing's remaining in expansionary territory. And a lot of this recovery has to do with they've expanded to the Southeast Asian markets while they've been smacked with tariffs from Europe across to the United States. They've just found new buyers. One thing that remains a big source of hurt for the Chinese economy is obviously the real estate sector and all the municipal debt that's really been accrued as a result of building all these projects. So real estate remains a big, big concern for their economy. We go to Japan, the yen kind of fell to the lowest part against the dollar, pegged against the dollar since going back to 1987. At the same time, Japanese are experiencing nominal GDP growth. It's on track to be 3.1% this year. If we achieve this at the end of the year, it's going to be the strongest growth Japan's had since 1991. For the longest time, they had a deflationary economy, and they managed to get, a little bit of inflation in what is a very old, labor market. The average age of the Japanese is significantly older than the United States, and is significantly older than most countries in the OECD as well. India is definitely, has a lot going for it. Between 2014, 2023, India went from the ninth largest economy to the world's fifth. It's a big part of the reason why we put it on this report. It is no longer kind of a large but peripheral economic zone. They're definitely playing with the big guys. And they've had the highest PMI rating in June and highest demand and hiring activity in 19 years. On the other side, you've seen a political shift in India as well. Under Modi, it's obviously become a more nationalistic and right-wing party, particularly around Hindu nationalism. And their most recent elections, while the BJP and Modi kind of secured the spot, he remains prime minister, there was definitely a lot of bleeding in their parliamentary elections. So voters have kind of shifted to the other side in India as well. Whether that is a long-term shift or a short-term shift, we'll have to see. There's, in the upcoming elections. Dalbar, created their 30th publication this past year, and I just really wanted to kind of highlight this quarter, kind of what 2023 looked like now that this publication is out. And we could see that 2023 showed one of the largest investor gaps in the last 10 years. Average equity investors finished the year with a gain of 20.79%, and the difference between the average equity investor and the S&P 500 was about 550 basis points, right? So last year. So it goes to a long-term trend that because of cash flow issues, poorly timed distributions, investment expenses, and yes, investor behavior, things like loss aversion, narrow framing, confirmation bias, all these things have caused over the last 30 years the average investor to and oftentimes significantly underperform the indice they're trying to track, the S&P 500, or in the case of fixed income investors, the Bloomberg's Barclays Aggregate Bond Index. terms of, we ran a survey, right in the beginning of July, and we were kind of asking people what their biggest concerns were. And 54% of people believe that the stock market returns would be greater over the next 10 years than the previous 10, which surprised me, quite frankly, looking at valuations and everything else that's happened with the stock market. At the same time, only 49% of respondents feel very prepared to retire compared to the 51% who do not. When we looked at the biggest economic concern, breaking it down from home prices, general goods inflation, stock market valuations or potential sell-off, and growing unemployment, general goods inflation was there at 55%, home prices 23%. So obviously, because of the last 2 years and the sticker shock associated with all this, people are still have inflation very top in mind. That's even occurring in a backdrop where inflation's going down, unemployment's creeping up, but people have had a full labor market over the last couple of years. They've had very good stock returns. So despite the fact that employment might be creeping in, they still feel, the peak employment between ages of 25 and 55 is the highest it's been in a long, long time. And, they still feel a strong employment market and strong stock markets, and they still have that sticker shock based on prices going back from the last couple of years. Annuities, solid Q1. They were 13% above last year's results at $106 billion, roughly. We see that fixed deferred annuities still kind of remain the primary sales driver. They had about 40% of the annuity market in Q1 2024. Q2 hasn't been compiled in its entirety, so we're using LIMRA's most recent data set that we didn't touch on the last quarterly update, which is Q1. And, we've seen that fixed index annuities have also gone up a lot. In 2023, they were $95.9 billion. My indication would be at this point so far from inflows that we will have a $100 billion year for fixed index annuities. RILAs have maintained a strong growth. VAs have been up a bit too, 7% over the year. However, sales are still kind of on historic lows as RILAs have kind of taken up part of that market. Structured notes have grown 5.5% this quarter to $28 billion. It's a 15% increase compared to the same time this last year. We see that volatility in some single stock underliers has increased, especially when we're looking at the Mag 7. The big thing to look at as the S&P continues to hit new all-time highs, we're going to anticipate more investors will look at buffered strategies for downside protection. And with that, that's really the end of our quarterly report. We've highlighted some of the big blogs that Tim's written alongside a podcast where we had an interview with our friend George Robinson. So please give this document a read, and we hope you enjoy. Thanks for your time.
Thanks all.